Welcome back to the Deep Dive, where we do a deep dive into a specific topic based on research you've shared with us.
Mm.
Today, we're tackling the question of whether Citigroup stock is a good fit for your portfolio.
Okay.
We'll be examining their recent financial performance, innovation pipeline, and acquisitions, along with their valuation and dividend policy. We'll also touch on their economic impact and ESG factors.
It's a lot to cover, but understanding these elements can really help you make a more informed decision about whether the stock aligns with your investment strategy.
Exactly. Let's start with a brief history of Citigroup. They have a fascinating story dating back over 200 years to 1812 when they were founded as the Citibank of New York.
It is remarkable how they've weathered so many numerous economic storms and navigated significant changes in the financial landscape. Over 2 centuries, they've gone through periods of rapid growth mergers and even a government bailout during the 2008 financial crisis.
Yeah, it's also interesting to note that Citigroup has a history of innovation. They were pioneers in developing many of the banking services we take for granted today, including things like compound interest on savings accounts, unsecured personal loans, and even customer checking accounts.
These innovations really highlight their adaptability and ability to evolve with the times.
Now let's fast forward to the present and delve into their recent financial performance. For 2023, Citigroup reported over $78 billion in revenue and a net income exceeding $9 billion. How do these figures reflect their current financial health?
Well, these numbers indicate a continued recovery from the 2008 financial crisis and suggest they are on relatively solid financial footing. Their profitability has been increasing, which is a positive sign for investors.
To assess whether Citigroup stock is a good buy right now, we need to consider its valuation. How do metrics like the price to book, or PB, and price to sales, or PS ratios, paint a picture of their current value?
Citigroup's current PB ratio is approximately 0.77, which is considerably lower than the industry average. This suggests their stock might be trading at a discount compared to their peers. Their PS ratio stands at around 12.08, which is also lower than some of their competitors like Bank of America and Wells Fargo.
So based on these valuation metrics, Citigroup stock might appear attractive to value investors. But it's important to look beyond just the numbers. Let's talk about their innovation pipeline. What steps are they taking to stay ahead of the curve in the rapidly evolving world of finance and technology?
Well, their move to migrate their infrastructure to Google Cloud is a significant step towards digital transformation. This could enable them to leverage advanced technologies like artificial intelligence to enhance their operations and potentially gain a competitive edge.
That's a good sign for investors looking for companies that are embracing innovation. Speaking of innovation, what about their recent acquisitions? What strategic moves have they made to bolster their offerings or expand into new markets?
They've been strategically acquiring companies in areas like digital remittance and investment technology. These acquisitions aim to enhance their capabilities in key growth areas and position them for future success. For example, their acquisition of a digital remittance platform allows them to tap into the growing market of cross-border payments.
These acquisitions signal a proactive approach to staying competitive. But of course, we need to consider the broader economic context. How might macroeconomic factors such as inflation, interest rates, and global economic growth potentially impact Citigroup?
As a global financial institution, Citigroup's performance is inherently intertwined with broader economic trends. Factors like rising interest rates could impact their lending business, while a strong global economy could lead to increased demand for their services. It's essential for investors to monitor these macroeconomic influences as they can have a significant impact on Citigroup's profitability. Welcome back to the deep dive. Before we move on to dividends and ESG factors, it's important to dig a little deeper into Citigroup's decision to exit consumer banking in 13 markets. This might seem counterintuitive, but it's part of a larger strategic shift.
It's definitely a move that raises questions. Why would a bank pull back from a sector that interacts with millions of everyday customers?
It's about focusing on areas of strength and profitability. Citigroup is not abandoning consumer banking entirely. They're strategically choosing to concentrate on markets where they have a strong presence and can achieve higher returns.
So they're streamlining their operations to maximize efficiency. It's a classic business strategy.
Exactly. This move allows them to allocate resources more effectively and aligns with their emphasis on security services, their most profitable unit.
Speaking of security services, can you explain what this unit does and why it's so central to Citigroup's profitability?
Sure. Security Services provides a range of services to institutional clients, including asset custody, fund administration, and securities lending. It's a complex but highly profitable business, and Citigroup is a global leader in this space. Their focus on security services indicates a shift towards serving large institutional investors.
Now let's shift gears and discuss a topic that has generated a lot of discussion. Citigroup's stance on gun control. They've implemented policies that restrict certain firearm-related transactions by their business customers. This decision reflects the increasing pressure companies face to take a stand on social issues.
It's a complex issue with strong opinions on both sides. Citigroup's decision to take a stand on gun control demonstrates their willingness to engage with social issues that they deem important, even if it means facing potential backlash.
It's a bold move, but also highlights the importance of ESG factors in today's investment landscape. Let's talk about Citigroup's dividend policy, a key consideration for income-seeking investors. They offer a forward annual dividend yield of around 3.15%. But how sustainable is this dividend?
Well, while their current dividend seems stable, it's essential to remember that dividends are never guaranteed. Companies can adjust their dividend policies based on financial performance and future outlook. It's worth noting that Citigroup did cut its dividend drastically during the 2008 financial crisis.
So investors need to consider both the current yield and the company's dividend history. What about share buybacks? How do these factor into Citigroup's strategy for returning value to shareholders?
Share buybacks are another way companies can return value to shareholders. When a company repurchases its shares, it reduces the number of outstanding shares, which can increase the value of the remaining shares. Citigroup has utilized share buybacks in the past, indicating their commitment to enhancing shareholder value.
Now let's turn our attention to ESG factors, which stand for environmental, social, and governance. These factors are becoming increasingly important for investors who want to align their portfolios with their values. We've already touched on the social aspect with their stance on gun control. What about their environmental practices?
Citigroup has been making efforts to reduce their environmental impact. They've set targets for reducing greenhouse gas emissions and have been investing in renewable energy projects. They've also committed to promoting sustainable finance, which aims to direct capital towards environmentally friendly initiatives.
So they're taking steps to address their environmental footprint. But it's crucial to acknowledge that, like many large corporations, they have also faced criticism for their involvement in financing fossil fuel projects.
That's a valid point. It highlights the complexity of ESG analysis. It requires looking beyond the surface and considering both the positive actions a company has taken and the areas where they could improve.
Ultimately, evaluating a company's ESG performance involves weighing various factors and forming your own judgment based on your personal values and investment criteria. Now let's move on to the final part of our deep dive, where we'll summarize the key takeaways and discuss the pros and cons of investing in Citigroup stock. We've covered a lot of ground in our deep dive into Citigroup. From their 200-year history to their latest moves in fintech and ESG, we've explored the key factors that could influence their future and impact your investment decision. Now, let's bring it all together and weigh the pros and cons of owning Citigroup stock.
Okay, so on the positive side, Citigroup has demonstrated a steady recovery since the 2008 financial crisis. Their revenue and net income figures for 2023 are encouraging signs of financial health and stability.
Their strategic moves, including streamlining operations and focusing on high-growth areas like security services, also suggest a commitment to enhancing profitability.
Yeah, and their valuation metrics, particularly their PB and PS ratios, indicate that their stock might be undervalued compared to their peers, which could make them an attractive option for value investors.
Their commitment to innovation is another positive point. Their move to Google Cloud and investments in fintech signal their willingness to adapt to a rapidly changing technological landscape.
And for income-seeking investors, their current dividend yield of 3.15% is appealing. They also have a history of share buybacks, which can further enhance shareholder value.
However, it's crucial to consider the potential downsides as well. Rising interest rates and increased regulatory scrutiny could pose challenges to their profitability.
Right. And while they've made strides in their ESG performance, they've also faced criticism for certain practices, highlighting the complexity of evaluating a company's commitment to environmental and social responsibility. Their dividend, while currently attractive, has been cut in the past during times of economic stress.
So the question remains, is Citigroup stock right for you? It depends on your individual investment goals, risk tolerance, and how you weigh the various factors we've discussed. If you're a value investor who believes in their long-term growth potential and are comfortable with some level of risk, Citigroup might be worth considering.
But if you prioritize consistent dividends or have strong concerns about their ESG performance, you might want to explore other options. Ultimately, thorough research and careful consideration are essential before making any investment decisions.
That's a great point. Investing is a personal journey, and what's right for one person might not be right for another. We encourage you to continue your research on Citigroup and any other companies that pique your interest. Explore their financial statements, read analyst reports, and consider how their business aligns with your investment philosophy.
And remember, the world of finance is constantly changing. Stay informed, stay curious, and never stop learning.
Thank you for joining us on the Deep Dive. We hope this deep dive into Citigroup has provided you with valuable insights to help you navigate your investment journey. If you enjoyed this episode, be sure to subscribe to our YouTube channel for more deep dives into fascinating and relevant topics. And let us know in the comments section what you'd like us to cover next. We appreciate your feedback and look forward to exploring more with you.